Pure Financial Advisors, a registered investment advisor. This show does not intend to provide personalized investment advice through this broadcast and does not represent that the securities or services discussed are suitable for any investor. Investors are advised not to rely on any information contained in the broadcast in the process of making a full informed investment decision. This is Your Money, Your Wealth on Talk Radio 760 KFMB. Now, here's Joe Anderson and Big Al Clopine.
Hey, welcome back to the show. Show's called Your Money, Your Wealth. My name's Joe Anderson. I'm a certified financial planner. I'm with Big Al Clopine. He's a CPA. Thanks for tuning in today. Hopefully you're enjoying your wonderful weekend. I know I am.
You're standing today. I'm looking. How you? What, about 6'3", 6'4"?
6'5".
6'5"?
6'4.5"-ish.
Jeez. I mean, I'm sitting in this seat looking up at this giant towering over me. How's standing? Does it work better standing?
You know, it's morning. I'm tired. So yes, I thought I would stand today just because I see other people do it. I was like, well, why are they standing?
To try it out, yeah.
That looks stupid.
Yeah.
But guess what? I'm enjoying it.
You like it? No,
yeah, it's keeping me fresh.
Yeah, I noticed you're like tight today.
Yeah, I'm a little spry.
Yeah, just,
a little angry too.
It's like,
see, when I'm sitting down, I don't care.
It's like everything whatever. I say. It's a debate, right? You know, Joe, there's some propositions in California, and I don't really want to talk most of them, except for Prop 55.
I want to talk about Prop 60 too.
Okay, all right, we'll get into that. So Prop 55, well, let me explain. Proposition 30 that we all voted on, I believe it was 2012, this extended the income tax brackets for the state of California. Because before that, the highest bracket was 9.3%. And so Proposition 30, way back in 2012, said, all right, if you're single, and these are the current brackets, at least this is for 2015. So if your taxable income in California is single above $263,000, it goes to 10.3%, $315,000, 11.3%, and $526,000, 12.3%. And also, Joe, when you get to $1 million, then it's 13.3 because there's this mental health tax. Now, when you're married,
mental health,
and it's for you because we know we're going to need it. It's gonna cost,
I just gave you that. Just threw it up there.
It's going to cost millions. Every single taxpayer in
So
California.
we just call that the Joe Anderson tax.
Fund when he finally loses it. So when you're married. It's a little over $500,000 where your tax goes to 10.3 and so on. So anyway, this was set to expire in 2019. So we've got a Proposition 55 that says, you know what, this is a pretty good idea. Let's extend it to 2030. So that's what the Proposition 55 is all about. And I remember way back in 2012 when this passed, and it was retroactive, which didn't really seem fair.
I haven't seen any commercials on it.
No. Well... You
just see the smoking one all the time.
The marijuana one?
No, like cigarette or like don't. It's all, you got one guy saying, "Oh, my kid died of smoking cigarettes, so please vote for this," and then another commercial is like, "Oh, all it is going to the insurance companies."
Okay.
I don't know what prop that is. I should
don't
have been
vote
a
for
little
that
bit more
one.
prepared for that one.
That was really good.
Yeah, wasn't it?
All right, let's put another couple dollars into the mental health fund for Joseph Anderson.
Please.
So anyway, I remember what I was going to say was back in 2012, it was passed retroactively, and the thought at that point was that there was going to be a mass exodus of wealthy people because the tax rate was going up. And it's in some ways,
Phil Mickelson.
I suppose that's a valid concern. Yeah, that's true. In fact, he was going to leave and go to Florida a couple of years ago, and then stayed. But I understand his home's on the market. I heard. Yeah.
Well, look at the inside scoop from Wow. We got a new segment, Deb.
I could tell you all this stuff you wouldn't necessarily know. At least that's what I heard, anyway. But I guess for a lot of us, this doesn't really matter. It doesn't really apply because.
So why are we bringing it up?
But it's something that we're going to be voting on here, and it's taxes, and we talk about taxes.
So let me ask you this because, all right, the property taxes, that's Prop 60. Well, Prop 13 is we have the lower property tax.
Right.
Right, but like Prop 60, isn't that when I can carry my tax basis to a equal or lower home?
Yes. So
if I'm 55 years of age or older.
Yeah, so once in a lifetime.
Okay, so I got this question.
Okay.
And this was the first time I was actually stumped in quite some time.
Really?
Because I didn't know it was once in a lifetime.
Mm-hmm.
Because I was, like the 121 exclusion.
Yeah, it's every 2 years.
It's every 2 out of 5 years that you live in your primary residence. You can exclude the gain.
Yep.
And then so the individual was like, well, how many times can I do that? And I'm like, when you get asked a question in a bubble like that without any context around it of what they're thinking or what their strategy is.
Yeah, right.
I'm like, well, what? I don't know. What? I'm like, what are you trying to do?
Right.
What's? Tell me that first,
Yeah,
and then I can maybe tell you if you can do it or not do it.
Right. You have enough time to figure it out.
Yeah, right. So here's what their strategy potentially was, is that they wanted to sell their primary residence and they wanted to move into a rental. Move into another property.
Okay.
All right. That was the same or lower value, so they could carry over their Prop 13 property tax basis.
Right.
Then they were looking at saying, hey, if I rent that out, can we move into another one? So I was like, okay, well, if I call that a rental, and then let's say I move to Nevada.
Okay.
Do I still get the Prop 13 on that property, right? I would still be able to.
I believe so, Joe. I think you can.
It's kind of stumped you now.
Yeah, you kind of stumped me. I think. So
or does it have to be a primary?
I guess the question is, does it have to be a primary residence or not? Here's what I'm going to say. This is what I think. I think maybe it needs to be a primary residence when you do it, but then it could be a rental after the fact, is my guess. But I'm not sure about that. But I'll tell you what I do know. Here's what I do know is it's a once-in-a-lifetime thing. Either you or your spouse have to be over 55. If you're married and one of the spouses uses it, it taints it for both of you. You get one per couple, right? So
if do both spouses need to be over 55?
No, just one is over 55, but then that taints it for that couple. And here's the idea, is that a couple is living in a home, and there's a lot of appreciation in San Diego, California, and now that's a lot of their assets. It's in their home. They want to downsize. They don't need as big a home. But if you downsize, your property taxes actually might go up, even though it's a less expensive home because of the way Prop 13 works.
Yeah, and Prop 13 is what?
Prop 13 is when you buy a home in year number 2, your property taxes can only go up 2% regardless of how much the home increases in value. So in a lot of cases, people that bought their home 30 years ago are paying the property taxes of a home that might cost half or a third as much as their current value.
Right, so their property tax might be based on $300,000 while they have a $1.2 million home.
Yeah, they sell a $1.2 million home, they buy a $600,000 home, and yet their property taxes go up.
Double.
So the idea is you get to take your base, and that's Prop 60, to one property has to be equal or lesser value. But actually something I just learned is if you buy you have 2 years before or 2 years after. If you buy the replacement property first, it has to be of equal or lesser value. If you buy it within the first year after you sell, it can be 5% higher, and if you buy it within 2 years after you sell, it actually can be 10% higher.
So this is where, when you look at it again with the overall retirement income strategy, and you're looking at downsizing, upsizing, moving, selling, buying, when it looks at your primary residence, your retirement accounts, your Social Security, and everything else in between, you want to make sure that you look at everything. In taxes, here, right, we've seen individuals that might increase their overall property tax bill. Right, and then all of a sudden their cash flows are a little messed up. So having this forward-looking strategy is key. Got to take another break. Show's called Your Money or Wealth.
Now back to Your Money, Your Wealth on Talk Radio 760 KFMB.
Hey, welcome back to the program. Show's called Your Money or Wealth. Joe Anderson, Big Al, hanging out. Go to purefinancial.com, purefinancial.com. Check us out online. Got my favorite part of the show, Al.
And what's that? Questions?
Email questions.
Email questions, okay.
Let's see. What do we got here? We got 1, 2, 3, 4, 5, 6, 7, 8, 9.
Okay, good.
We'll probably get through 2 of them.
Probably.
All right. So let's dive right in, because these are questions that most of you probably have a little inkling of wanting to know the answers to.
And you'll probably be able to tell as we start answering, we haven't heard the questions before. So we're not, this is just from our thoughts right off the cuff.
Here's one for Mr. Alan Clopine, who is a certified public accountant. What is the difference between gross income and taxable income?
Oh, okay. That's very good.
Because, all right, when you look at it, is that most people hear gross income, or then if you get really sophisticated, you might hear modified adjusted gross income or adjusted gross income.
Sure, right.
But taxable income, I think in your and I's opinion, is probably one of the most important lines that you want to know.
I think so, Joe, because that taxable income is going to determine what tax bracket you're in, which is going to help determine what tax strategies are going to be the best for you. But let's explain. So gross income is simply that. It's your income sources from things like salary, pensions, Social Security, interest, dividends, capital gains, and so on. That's your gross income. And if you look at your Form 1040, your tax return, I don't have it in front of me, but I think that's lines 7 through 28, if I'm not mistaken, or 22 or whatever. Anyway, that's your gross income. And then there's a bunch of things at the bottom of page 1. It's called adjustments to gross income. If you're self-employed, you can deduct your health insurance, you can deduct your pension payments. If you pay alimony, you get to deduct those, things like that. So you take those adjustments off of your gross income, and then that becomes your adjusted gross income, at least in terms of that's what the IRS calls it. That's what's at the bottom of your 1040, page 1 on your tax return. But that's not yet what you pay taxes on, because you go to page 2 and then there's something called itemized deductions and exemptions. Itemized deductions would be like your home mortgage, state taxes, property taxes, charity, things like that. And some of you don't have a lot of those, and the IRS says, you know what, if you don't have enough, we'll give you a standard deduction. We'll let you have a certain deduction even if you don't have enough to itemize, which can be generous. And then there's exemptions. So you take your gross income minus adjustments, minus itemized deductions, minus exemptions, you get your taxable income. And that's what, line 43 of your tax return on your 1040? And that's going to show you what you're going to pay tax on. You take that number, Joe, and you go to a tax table and figure out what bracket am I in. I mean, 15%, 25%, 28, 33, 39.6, for example. And now you know if you add more income or you create a deduction, what either you're going to be paying in additional taxes or saving in taxes by creating that deduction.
Right. So if you look at your taxable income, line 43 on your tax return, second page of the 1040, just as Al said, is like, let's say you fall into the 15% tax bracket, for example. If you created a deduction, so let's say you gave more money to charity, that let's say you gave $1,000 extra to charity that year, well, you would save 15% in federal tax.
Right, so $150.
$150. So, or if you said, you know what, maybe if I added income, if I received a bonus, or if I, worked some overtime, or maybe you did some tax strategies and planning when it comes to adding income by taking more distributions from a retirement account in regards to a Roth conversion, then you're going to be paying 15% in tax on that additional income until you breach the next bracket, which would be 25. So you look at the taxable income, and then that's going to tell you if you add $1 of income or you subtract $1 of income, what the overall tax bill is going to be or what the tax savings is going to be. And if you don't know that number, I would encourage you to look at it and understand what the tax tables do, because that will change how you look at your overall retirement strategy when it comes to taxes.
Yeah, for example, this is a real simple example, but sometimes when people look at their taxable income and they find out they're in a pretty low bracket, let's say a 15% bracket, and then they're also doing an IRA contribution, which is if you have earned income, it's $5,500 per year or $6,500 if you're over 50, because they want the deduction, but yet they're in a really low tax bracket. An individual in that situation probably should do a Roth contribution, because a Roth is going to grow tax-free, and when all that money is withdrawn, there's no tax to pay, and the tax deduction that individual receives isn't that great because they're in a low bracket. So many times we see people doing the wrong things in the wrong brackets just because they didn't really take a look at where they were at.
Right. I mean, because you can take a rule of thumb type of advice. Money Magazine, Kiplinger's, radio, whatever. And you're like, okay, well, here, I should contribute to my 401k plan. All right, well, if you're only saving, let's say, $5,000 into the 401k plan, and assuming that there is no match, you should open up a Roth IRA and put it in there, because the tax savings that you're getting in that 15% tax bracket, it might be better if it was an after-tax contribution. You pay the tax and then have all of that money grow 100% tax-free.
Right.
So you have to look at your tax bracket to make the right moves. So.
Now, on the other hand, Joe, sometimes people will find they're subject to alternative minimum tax, and there's different levels of alternative minimum tax. But generally, when you first hit that alternative minimum tax threshold, which is different for everybody, so I can't tell you at what income level
I know
that occurs.
It's so stupid. It's all dependent on your deductions.
It depends, but let's just say somewhere around $200,000 of income maybe more, maybe less, but just so that you have an idea. You might be subject to alternative minimum tax, and now your marginal rate is going to be closer to 35%. Okay, plus state, which is 9.3. So it's almost a 45% tax rate between federal and state. And so there, it's like, should I do a Roth contribution? Well, you may not be able to because your income is too high. But let's just say you qualified for a Roth contribution. Maybe an IRA contribution might be better for you because you're in such a high tax bracket. And so that's the kind of thing you got to look at. That's why this taxable income is so important.
Right. And then for those of you that have the Roth provision in your 401k plan, right, you want to look at your taxable income. So let's say you're maxing out your 401k, which is $18,000 if you're under 50, $24,000 if you're over 50. And so you want to be a little bit more strategic here to say, all right, well, if I want to put $24,000 into my retirement account, and if I have a Roth provision in the 401k plan through my employer, meaning that they have both sides of the equation, that you can go pre-tax or after tax, look at your taxable income, line 43 on your returns. See what tax bracket that you're in. Because you could be, let's say, $10,000 in one bracket, right? So you might go $10,000 pre-tax to get you into a lower bracket, and then the remaining $14,000 you would go into the Roth, or vice versa. So looking at taxable income and understanding what that means to you is going to dictate what type of planning. You're going to be a lot smarter for it. And guess what? It takes 5 seconds to open up your tax return to look at your, to see what bracket you're in.
Yeah, that's a really good thought, Joe. And just a quick example, let's say your taxable income is $85,000 and you're married, right? And you haven't done any 401k. I'm just making this a real simple example, but you want to do a full $18,000 401k. Well, in that example, you would do $10,000 in the regular 401k to bring your taxable income to $75,000, which is the top of the 15% bracket, and the other $8,000 would go into the Roth side because the other $8,000 would not give you that great a deduction.
Got to take another break. Show's called Your Money, Your Wealth.
This is Your Money, Your Wealth on Talk Radio 760 KFMB.
Hey, welcome back to the show. Show's called Your Money, Your Wealth. My name's Joe Anderson. I'm a certified financial planner. I'm with Alan Clopine. Big Al, he's a CPA. Go to purefinancial.com to learn more information about us. We are a registered investment advisor, financial planning firm here in Southern California. Have offices in San Diego, Irvine, and in Los Angeles. Answering some email questions there, bud.
Yeah, I can't wait. What do you got next?
All right. Let's see here. This is from Larry in La Mesa.
Okay, good.
All right. Joe and Al, love your show. Longtime listener. Here's his question.
Okay.
I already have a personal IRA with a major mutual fund company. He's got a lump sum. My lump sum pension will be going into this account because it's all tax-free until I start to withdraw. I have a fear of commingling it with other investments which are at 60-40 split between stocks and bonds. What is your recommendation? I have a tentative fund picked out consisting of 88% bonds, 12% in a stock fund. This fund is the least risky fund right above money markets on the company's risk and benefit sliding scale. Any thoughts? Well, first of all, thank you for listening to the show. Appreciate that very much. Second, we're not going to give you a recommendation over the air, but we could give you some thoughts.
Okay, that's a good point, Joe. Because there's a lot more questions to be asked
about 1,000
before we really dive into this. But so anyway, but you got an IRA already, great.
So I guess there's a couple of different questions. The first question is that all right? Well, here I already have an additional IRA. I got a lump sum. He's afraid to commingle the accounts.
Yes, good point. First
so
question.
what do you think about that?
I don't have any problems with that. Because here's why. Because when you have a lump sum and it goes into your IRA, it's all still tax deferred money. You can invest it. There's no reason to worry about that, I guess, because it's all it's all pre-tax, or maybe if you got some basis, it doesn't matter. In fact, if you put it in a separate IRA, the IRS looks at it as if it were one IRA anyway. So there's no danger in commingling.
So I think one of the things, he's got it with a major mutual fund company. So with that, because maybe everything is in one fund, he might have a balanced fund.
Yeah, and remember, it used to be, Joe, the rules, this is years ago, where you wanted to segregate your rollover IRA from your pension, so then you could roll it back in, and you couldn't, in many plans, you couldn't roll an IRA back in. And those rules it's just everything's kind of blended together now. It doesn't really matter.
So if you have a brokerage account, then you could pick all sorts of different fund families within the brokerage account. So maybe you want to look at that. Or if you like the fund family and just directly with that fund family, that either sounds maybe as a, well, whatever. It doesn't necessarily matter. But I agree with you, right? It's a lump sum. He decided to take the lump sum. You move it into the same IRA or open up another one. I would just put it in the same IRA, because when you get older, then that's one less account that you have to worry about.
It's easier to track. You get one set of statements instead of two, right?
And so here's the other question within that was like, okay, well, I don't want to commingle. Well, no, that's all right, commingle. Second question is, all right, well, I got this other fund picked out that's a lot less conservative. So he's thinking with the money goes in, right, he has to set up maybe a separate account to have this less conservative type of investment.
Yeah.
Again, if you have like a brokerage account, right, you can have multiple different mutual funds with multiple different risk parameters. With you know what I mean? You could have 15 different funds with 15 different risk characteristics, all in one account.
If you felt like it, yeah, you could have a completely new investment inside this IRA. You don't even touch the old ones.
Right. So you keep the existing one 60-40, and then with the money that's come in, then you use your 88%, 12%.
Bonds. So that's actually, you said more aggressive, but it's actually more conservative.
Well, I'm just reading what he told me here. I have a tentative fund picked out consisting of 88% bonds of all types and 12% a stock fund.
Yeah.
This fund is the least risky fund, right above money markets on the company's risk and benefit sliding scale.
Yes, but you said more risky. Go back and run the tape.
All right. Podcasters, please call my office.
Who is right? Anyway, I guess the broader question, though, is that there's a lot of questions to be asked to figure out how you should be investing. So we don't know, are you working? Are you? I assume he's retiring because he's getting a lump sum, but maybe he's getting another job, right? So when do you need the money, right? What's your cash flow needs? What's your fixed income? What sort of drain do you have to have on your portfolio to cover your lifestyle? All right, now that's going to start to help us figure out what rate of return that you need. Now we can work backwards and devise a portfolio to earn that rate of return with the least amount of risk.
Very, very true, my friend, very true, because it's not like, all right, well, here I'm retired. I'm going to put everything in this 88% bond fund that's right above a money market, he's saying, right? From a risk to return scale. I don't know what scale he's looking at.
Right.
So it's like, all right, well, here, maybe you need to take on more risk. How old are you? What's the longevity? Inflation is a true risk that you're ignoring here, potentially.
Right. And what if you don't need it?
Right.
What if this money is for your kids?
For charity.
Right, or charity. Then let's be a little more aggressive.
For 30 years, let's say, you know, if you're looking at a 30-year life expectancy, or you back it out, and just like Al said, it's like, all right, well, what is the money for? How much money that you need to provide you with the retirement income that you're looking to do? And then take the least amount of risk possible to help you achieve that goal. But you might have multiple goals. One is for retirement income, one is for legacy planning, one is for charitable planning, one is for college education, one is for whatever. So then that's why you can't look at this in a vacuum. And I think, unfortunately, so many people do.
I think a lot of people do. In fact, that's a lot of times.
Because it's too much work to go through all this.
I know.
God, killing me.
You got to think about it.
All right. Here's another one for you.
Okay.
This is from Janet.
San
Diego.
Like it.
All right. She didn't say Joe and Al love the show.
She said, I think your show is awful, but I'm going to ask you a question. Anyway.
You're the only ones that will
actually read
my question. I've been trying to talk to these other advisors for years, and they never talk to me.
20 years. I finally get someone to read the question.
All right. So I took out a personal loan of $8,000 for debt consolidation purpose with my credit union.
Okay.
I'm simply wondering if this loan will affect my income tax in any way. Do I report the loan on my taxes? Will it make a difference in how much my refund will be? So she took out a personal loan for debt consolidation purposes. Yeah. And then so she's wondering, hey, what's going on? Will this loan affect my taxes?
Okay, Janet, that's an easy question to answer. It's I assume you probably borrowed this money to pay off debt consolidation, credit cards or whatever. So when you borrow money, that's not a taxable event, so you don't have to report it anywhere. So as a matter of fact, $8,000 may have come into your checking account or your savings account, wherever you put it, but that's not income because it's debt. And the reason it's not income is because you have to pay it back, right? If you think of normally income, taxable income is money that you receive that's yours, that you did for earning something or profit on a stock or bond or something like that. But no, this is borrowing. So it's not a taxable event. You do not put it on your tax return, and it will not affect your tax refund.
Can I obtain a loan on a quitclaim property? All right. So this is Jerry from Orange County.
Okay, good.
I'm proposing that my father enters into a quitclaim to transfer the interest of one of his properties to me.
Okay.
I have an average credit score and employed as a barber. I wonder if it's one of mine.
Maybe.
Maybe he's disguising his name. I got one in Los Angeles and I have one in San Diego.
Still have the two shops. Are you going to expand?
Debonair.
Yeah.
Yeah, look at San Francisco.
Nice.
My concern is that I will not be able to take out a loan on the property. The title is free and clear, meaning it is fully paid for. What are my options or obstacles in obtaining a loan?
Well, that's a good question. So, Jerry, it's a quitclaim deed means now that the property is in your name. That's about all it means. And so now you have complete title to it, and it's free and clear. So you have the ability to finance it subject to your own ability to pay back the debt. So it's going to be based upon your income, right?
So dad gives son the property.
Yeah.
So then the property is in the name of the son. So there's no financing required there because the house is paid off.
There's no financing required, right?
But dad probably wants some cash,
that's
right?
what I'm thinking. Yeah, maybe dad wants cash or maybe Jerry wants cash for something else. And so you can borrow on that property. It's free and clear. It's a refinance. It's not a purchase. And we're not mortgage lenders, but it's a little bit different refinancing maybe. But at any rate, yeah, it's free and clear. As long as you can qualify for a loan, you can refinance it and pull whatever cash out is subject to the property value, your income, what the lender feels they can lend to you, and that sort of thing.
And, well, Al, you've been a real estate investor for quite some time, and I know you're not a mortgage lender, but this is just a question here for Jerry. So he's a barber, right? So I own 2 barbershops, so I understand the income limitations of barbers.
Sure.
Some of them can make a lot of money of them. Some of them can't, but right, they're not making millions of dollars a year.
Right.
And I think Jerry's one of these individuals that says, you know what, I'm making a decent living for myself.
Sure.
But I'm worried about maybe qualifying for a loan.
Right.
So will a lender look at this differently, just in your opinion, right?
Yeah.
Just as a couple of kids here hanging out.
Yeah, right.
So if I have $1 million house paid off and I'm on title of that home and I just want to refinance, maybe take $100,000 out versus me purchasing $1 million home,
yeah,
will they look at my qualifications different?
I don't think so, Joe. I think I think the reason why I say there are differences is when you purchase a home, you can sometimes put minimal down payments, and when you refinance and pull cash out, I think a lot of banks will want you to have at least 80% loan to value, if not 75%, if not even 70% loan to value. In other words, there's a lot of equity in it. But
if it's totally paid off and I just want to do $100,000,
sure,
let's say refinance,
so
I still have $900,000 of equity.
Right. But it's going to be subject to your ability to repay the loan. So a traditional loan, the lender. I guess it would be based on whatever I'm trying to take out. If I'm only trying to take out $100,000 on $1 million loan, they would look at the repayment capacity of $100,000. Yeah. So what I was going to say was on a traditional loan, the bank looks to the borrower as the primary source of repayment, and they look to the property itself, secondary collateral, as a secondary source. Now, there are asset-based loans that you can get even without income. You tend to have higher interest rates, from my understanding, but that would be a possibility, let's say, if Jerry's income isn't high enough to get the loan he wants.
Right. All right, we got to take another break. When we come back, that's it for us. We're going to wrap this show up, Al.
Sounds good.
The show's called Your Money, Your Wealth.
This is Your Money, Your Wealth on Talk Radio 760 KFMB.
Hey, welcome back. Wrapping up the show here today on Halloween weekend.
Yeah, it is. You got big parties you're going to?
Absolutely not. I hate Halloween.
You're not a costume guy, are you?
I can't stand them. Because my mother used to dress me up in the worst costumes possible as a kid.
Oh, that's good to know. I'm going to email her and get some pictures.
It was, oh my gosh. And she would, they were just bad.
Bad costumes.
I look at my nephews. It's like, wow. These are cool costumes. I would have loved Halloween. No, not me. She would dress me up in
like what? Like Scarecrow or something?
No, like a businessman. Like an old man. I would wear like a suit. And then so she would put like this weird, like these old glasses and a mustache, and then I would wear a wig. And then so I'd go to, I'm in 6th grade, and we do the, maybe in 4th grade. I forget. I'm torn, Al. I'm scarred. And everyone's in Spider-Man, right? And all these cool costumes. And here's me. Right. I'm wearing a jacket that's too big for me. It was my father's.
Right.
And some like baggy pants, and I got a briefcase, and I got a bushy hair, and like some old spectacles and a mustache.
Yeah.
I'm like, what the hell? What am I, Mom? An old man?
Did you have to put the candy in the briefcase? Open it up when you got to the door?
Pretty much.
Trick or treat?
Yeah. She wanted me to be a CPA. Apparently. That's why she's got a big crush on Big Al.
It didn't stick, that
it didn't stick. Yeah, what are you going to dress up?
No, I feel the same way as you. I can't stand it.
Oh.
I mean, I get roped into a Halloween party probably once every 5 years, and the last several years always the same thing. I just am a cowboy because I happen to have some jeans, some cowboy boots. I got an old cowboy hat. I got
Woody
flannel shirt.
Yeah,
Woody.
Yeah,
right.
Woody. There you go. I'll be Buzz. Let's do this.
Yeah. All right. Okay.
I did dress up last year, and I didn't want to, and I was made to, but it was all right. It was.
Oh, is that the face painting one you did?
Yeah.
That you got the half a face painting?
Yeah, half a face.
That was kind of cool, actually.
Yeah, then a good friend of mine, she got her face painted, and it was like kind of like a skeleton or something, right?
Yeah, right.
And then I had this T-shirt that was a skeleton, and so I just wore a T-shirt, put a jacket, boom, face paint. Good. Let's go. Let's have a beer.
Good enough.
Yeah. Lasted about half an hour at the party.
Yeah, you're dead.
I'm done.
Okay. Don't you just love it where people try to act in character?
Oh, it's like awful. I just want to hit them. I do. It's just so. It's like, will you stop, please? Oh my God! I was at this party and there was a bunch of people like in The Walking Dead, and then, like zombies, and they're acting like zombies and stuff. I'm like, are you kidding me? Hey, how's it going, Frank? Like, God, if I had a...
I mean, and all these costumes, I suppose if they were all kind of related, it might be kind of fun, but it's like, okay, you got a cowboy, you got Walking Dead, you got a baseball player. It's like, what?
Oh, yeah, I know. They really get into character. Some people just go way overboard.
I know.
And then I'm like, you're 65.
Yeah.
What are you doing?
Right.
Just go to bed.
Yeah, I told you, I've never been into costumes, but I tried. It was a costume party client of mine. This was 20 years ago or so, more than 20 years ago, because Robbie was a baby. And so I thought, okay, I'm going to do my best. And I've never gone to a costume store. I just get
Did you go to Buffalo's Breath?
Whatever. No, they didn't have such things.
Oh.
I mean, maybe they did, but I just went into my closet and got some stuff. I got some face makeup. I put all kinds of stuff on. I had this weird wig, weird clothes, and the whole night everyone goes, "Who are you?" I go, "I didn't know you have to be anything. I'm just different."
What are you supposed to be? I'm Big Al.
I don't know. Different.
Oh, yeah. This one year was so bad. I had to wear this like 70s shirt, right? It's like Mikey Martin is one of my best friends.
Yeah.
They can't get enough of Halloween. If Halloween was every night, they would be the happiest people in the world.
Yeah,
right?
Right.
And I'm like, no, I hate Halloween. I'm not going out. And, no, you're going out. And I was like, okay, whatever. I go, I'm not dressing up. No, you have to dress up. So then they give me this like skin tight like 70s shirt. Right, with the big collar, right, it's short sleeved, and then I got these bell bottoms on, and they gave me this wig, right, and then I'm like, okay, whatever, and I got, so I go to the party, right, and I'm hanging out, and I'm like you, hey, I don't have to be anyone. Everyone, hey, Greg Brady.
Yeah, right.
It's like, yeah. So I was Greg Brady one year. Apparently.
Well, no one could even do that with me. It's like, boy, that's. I don't know. I can't figure out who you are. Neither can I.
Yeah, then, you go to the haunted houses. Do you like to go into those things?
Not particularly.
Oh, I hate them. My cousin was in town from Tucson, right? So we go to the one downtown San Diego.
Yeah.
She gets so scared, she pushes me off the cat rope. I hit my head, right? I'm bleeding. Oh, and then I went with my brother. This is several years ago when we were kids. And so there was like this, some gorilla in a cage, right? And so we're walking by, and they got the strobe lights going. And we're kids. My brother's a big boy.
Yeah.
My brother's like 6'5", 300 pounds, right?
Right.
Like a lineman.
Yeah.
So we're walking down the catwalk, and then the strobe lights are going off, and all of a sudden, this guy rips open some bars, like he was in a cage, and the bars like were bent, and he threw his head out.
Right.
So what does my brother do? Hits him right in the face.
Oh, boy.
He got so scared, he hit him. That was his only. And right, guess what? Lights go on. We get escorted out. No, I'm like 12.
Right.
Yeah, those good times.
Well,
I do not have one fond memory of Halloween.
I do have one fond haunted house experience. I was probably, my younger son, was probably 12. His birthday, and it was October 18th, so we had a party with a couple of his kids. Universal Studios, they had a haunted house there. And I went into that with him and one of his buddies. And the two of them were so freaked. It was actually pretty funny. And the funniest thing, actually, we got out of there, and both.
So seeing your kids freak out and cry of
and so the one
is enjoyment.
Nothing better as a dad. Anyway, so we get out of this thing. The one kid that did it said, "I will never do that again." And Ryan goes, "Let's do it again." So two of us did it again. And he was just as scared the second time. That actually was a good memory.
That was an even better story, Al.
It was. But, Joe, do you know that thousands of Americans will unnecessarily pay the IRS this year on income they never received? And most of them won't even realize it.
Are you bailiffs right now?
Until it's too late. Yes, I am.
How about this? Why don't you go to our website, purefinancial.com. Have a wonderful weekend, everyone. Have a safe Halloween. Hopefully you will have a better Halloween story than Al and I just told for the last 5 minutes.
Yeah, it was awful.
Yeah, and email us some email.
Yeah, give us a better story.
Yeah, give us some good stories.
Yeah, for next week.
Like I said, have a great weekend, everyone. For Big Al Clopine, I'm Joe Anderson. You just listening to another wonderful episode of Your Money, Your Wealth. We'll see you next week.